Let's get more with Kieran Quain from FIG Securities with me in studio, and Sally Auld, interest rate strategist at JP Morgan. Good morning to you both. Sally, really that performance by US Treasuries, at what point do you call an overvalued situation as being one that's imminent?
Yeah, good morning, Carson. Well, it's an interesting question, actually, because I guess just over the weekend, JP Morgan strategists yet again revised down their forecast for US 10-year yields. So at the moment, basically the way they're looking at the market is saying, look, their model of long-run fair value sort of suggests around that sort of 250, 260 level on 10-year treasuries. Where we are at the moment, that's about fair value. But the problem is that model doesn't actually take into account the impact of more QE. So if we actually think there's a better than 50% chance that we're going to see a pretty solid QE program from the Fed later this year, then that actually biases our estimate of fair value lower, and we think maybe 2.25 is now where we see fair value on 10-year bonds. So for that reason, we think, at sort of 20, 30 basis points above that level, they look like a pretty good buy at the moment.
Kieran Quain, Sally, they're saying a pretty solid round of QE. Now, the chatter seems to be gaining ground. It could actually go against market expectations. Instead of shock and awe, we could see a drip-fed approach. There seems to be gaining currency around the table at the Fed. What are you hearing?
Oh, there is debate in the Fed amongst constituents as to whether or not it's a drip-feed approach or a shock and awe approach, a one slam bam approach. Either way, what we're hearing is that QE2 will likely happen, and the market's focusing on that, and therefore the yields driving lower. And in the absence of strong economic data to the contrary, suggests that yields can again fall.
Some also saying overnight part of the justification for the trend was, it's end of month, end of quarter approach. You get your window dressing coming into play as well. Does that skew, in fairness, these numbers?
Oh, really, that's a speculation. You can say that at the end of any quarter, at the end of any month, window dressing, etc. But no, I mean, they're addressing a real economic problem, and QE2 is possibly the answer.
Interesting, Sally, as well. Markets here talking debt for Australia. That is to say, the Access Economics call about, you've never had it so good into the future, untrammeled. That is certainly got to be playing on bond investors' minds, because I guess the chatter pre-election was, would a Gillard government spend up and go the Labor way?
Yeah, no, I think that's right. And I mean, it almost is a little bit nonsensical to look at the sort of quality of the debate here in Australia about debt levels, etc., when you compare them to a number of, much bigger and much more sort of, I guess, prominent economies in the global economy, such as the US, the UK, Japan, where the debt metrics are horrible by most standards. So for Australia, our fiscal situation is very, very sound. And I guess the question really that we need to answer as an economy or a nation over the next sort of 10, 20 years is the fact that, the good times don't last forever. We know that that's sort of history tells us that. And it's about building up a buffer while the times are good to sort of help you when the good times do actually start to end. And I guess fiscal policy is one way through which you can achieve those aims, running sort of surpluses while the economy is growing at or above trend, and you can accumulate those surpluses and use them should you need to ease fiscal policy, when the commodity stimulus is no longer with us, or the Chinese economy, slows unexpectedly, whatever it might be. But I think there's, the debate about the debt issue here in Australia is really sort of probably not the right one to focus on. And I think the more interesting and probably more pertinent question is, can we build up a good reserve for when the Chinese story starts to wane in its influence a little bit?
So really an elaborate way, Sally, of saying we need a sovereign wealth fund.
Yeah, I guess so. I mean, it's it's effectively, when it's sort of like you want to sort of smooth your consumption over the cycle, and so when incomes are high and times are good, you save and you use that for the period which eventually will come when all those forces go into reverse. So you can sort of argue that the Future Fund is a first step in that direction, but I think there are plenty of examples of commodity exporting countries, Norway being one, where they run very, very large sovereign wealth funds. And I think when you think that a country's investment horizon is infinite, it makes a lot of sense to do that.
Kieran Quain, though, we might be sort of splitting hairs over whether Access, Treasury and Exile has got it right or not versus the government's call, but it matters because terms of trade being as inflationary as they are, is where it's all at. This has been the thing that's, I guess, forced the Reserve Bank's hand, as it may do next week, and kept that 10-year level, the note, pretty much static.
Oh, well, that's true, yeah. The response to the Governor's comments of last week in the market, hence, has been that the short-dated bond rates have risen sharply and the 10-year rate's pretty much stable. And you know, in this environment, a possible curve inversion could happen. And you know, the focus on monetary policy at this point in time is all about the short end.
And bring that home into sort of the corporate bond space as well, because unsettled overnight, US financials, heightened capital ratio requirements from Basel III out of Switzerland for the sector. What does it mean for yields here in the corporate bond space?
Well, Australian corporate bond yields, or the high yield sector, Tier 1 especially, has been rallying quite strongly. The spreads have been contracting against Commonwealth benchmark yields over the last 2 weeks since Basel III announcements. There are a number of factors there. One, they were heavily discounted prior, and two, that the lack of supply in the market as well, or new supply in the market, is beginning to affect the prices for the existing exposure or the existing issuance.
And Sally, that whole issue of a bit of a supply drought, are you hearing that that could actually be broken, and if so, how?
Yeah, I think it's an interesting question. I mean, certainly domestically, you know, you sort of get the sense that corporates are reasonably well cashed up and have been pretty assiduous about terming out their funding. So I guess, you know, at the margin, that means that the sort of supply story for credit is going to be less than it otherwise would. But, you know, more broadly, when we look at economies everywhere, I mean, one of the sort of post-crisis, I guess, themes that is important for the corporate bond market and credit spreads more generally is that the supply of credit or credit growth in a lot of developed economies is going to be a lot slower than we're used to, and I guess with that comes slower or lower supply of spread products. So in an environment where investors are sort of constantly searching for yield, given that there's a good chunk of the world where yields are going to stay low for a long time, I think that means that the technicals are starting to have a meaningful impact on spreads.
And in terms of how that feeds through into our economic growth, Kieran, it's been interesting because, as Sally says, that the rate of growth inevitably going to slow. Now, the US approach has been to be very draconian with job shedding. Haven't seen that here, and we continue to hear stories about that's putting us on the back foot when it comes to productivity. Could actually low unemployment be, in this climate, a bit of an Achilles heel, perversely, for us longer term?
Oh, no, I don't think, other than if the RBA doesn't contain the inflationary consequences of a low unemployment and stretched capacity, then it could be an Achilles heel. But,
and yet its options are limited because, you know, as affordability rises, so you get utilities justified in putting up their prices. Reserve Bank can't touch them.
Well, that's one sector, I suppose, that is different, but there are many sectors that contribute to the basket of prices for which consumer price inflation is measured. But yes, monetary policy is a blunt instrument, and they can raise the official rate and have an effect on dampening prices within their band of 2 to 3% is their target, effectively. But they haven't got control over all sectors. Indeed.
Sally, how are you judging that? It's kind of perverse, isn't it, that we'd be talking about low rates of unemployment being necessarily not the best scenario now for taming inflation?
Yeah, well, I think it's an interesting story from the productivity point of view, because what happens is, as the labour market tightens up, I mean, the sort of the people that you drag into the labour force, or the people that you employ, are sort of the last ones at the bottom of the pool, so to speak. So their marginal productivity relative to, you know, the first person you employ is actually going to be a lot lower. So I think that does probably impact the overall productivity story for the Australian economy, which, you know, in a world where we're already starting to push up against capacity constraints, isn't great for the inflation outlook. And I guess, you know, as Glenn Stevens made pretty clear last week, that's the world we live in. We're going to be battling inflation given some of these sort of issues, and also given the structural changes that the Chinese economy is forcing on our economy. I mean, inflation is going to be the #1 story for the RBA, and I think, you know, that they would probably admit that, you know, they're going to be lucky to get it to average between 2 to 3% over the next sort of 5 to 10 years. You know, and we might actually have to sort of implicitly accept that, you know, something a touch higher is probably what we're going to have to shoot for.
You know, we know inflation for both of you is their mandate, but Kieran, are you surprised you don't hear more from the Reserve Bank about the level of debt that Australians are carrying and the sort of the fact that that's only adding to this problem now with house prices and the connection there? They don't seem altogether concerned about it.
Oh, they have talked about it at length on prior occasions.
But why have they then dispensed with it? I mean, why is that not an ongoing clarion call?
Oh, I think there has been an ongoing call about it. Be careful about the level of credit you undertake as a household. Going forward, you have a higher sensitivity to interest rate moves, the more debt you take on. And there have been warnings shot across the bow of every household in Australia by the Reserve Bank Governor. I think it almost to the point of been boring when it's continually relayed, so maybe this has just been a little bit quiet over the last
It's interesting, you know, we're approaching this sort of wage negotiation cycle now with the unions coming into play. The fact that such big demands are being made, is that telling you that union members are actually telling their bosses they're struggling? That they need these above inflation rises? I
think everybody wants a piece of the pie, and when things are good and they see the economy performing, they will make wage claims, ambit or otherwise.
Sally, to you on that one, how much above inflation should wage rises be, I guess, capped at comfortably in an economy like ours at the moment, at this point in the cycle?
Well, I mean, an economist would tell you that that depends entirely on productivity gains, you know. So if your productivity is growing at 3%, then I'm happy to give you a wage rise of 3%. And the problem where you run into sort of, I guess, wages influencing the inflation outlook negatively is when you start to give wage increases that are way above sort of any productivity gains. So I guess it's an interesting one, and I suppose the issue for the RBA has been that, you know, really over the last couple of years, wage demands have been pretty subdued because, you know, people sort of knew that there was a financial crisis sort of globally playing out, that the labour market here was actually, you know, getting slacker, not tighter, so maybe it wasn't the smartest thing to do to ask for a wage rise. That story is now well and truly behind us here in Australia, and I think workers are saying they feel like it's time for a bit of catch-up. They did the right thing during the crisis, and now it's the turn of employers to do the right thing by them. So, you know, I think the RBA can sort of sense that maybe some of the atmospherics around the labour market, around wages, around inflation, had the potential not to play out very favourably over the next 12 months. And for that reason, I think is why we're seeing a rate rise before Christmas. When you know, you go back a month or two ago, and the consensus from economists and from the market was firmly that we weren't going to see anything until 2011. But I just get the sense that the RBA knows it doesn't have the liberty of having time on its side, and it needs to sort of be a little bit more preemptive about these things than it might otherwise like to be.
So I want to get your views, both of you, finally on that one. Sally, I think when last we talked on the subject, you were calling October. You were saying they won't just play into the market expectations of waiting for CPI and then jumping. They'll be ahead of the curve. Have you changed your tune?
No, still very happy with that call. I think there's a good chance we'll see a rate hike from the RBA next week. And I think, you know, when you think about it sensibly, I mean, what these guys are trying to do is sort of not get themselves into a situation where, you know, should February 2011 roll around, the economy's got away from them, the inflation story's getting away from them, and they have to raise rates sort of 3 or 4 times in a row. They want to, if they can, sort of make this a gradual adjustment, or as gradual as it can be, given some of the stronger forces we know that are at work.
Karen, where are you sitting at FIG?
I think so, in October. They don't need to wait for the price data that's released at the end of October before acting. It's all about forward expectations of inflation, and they've obviously got enough evidence in the pipeline to be concerned, so I think they'd move sooner rather than later. It's
intriguing, isn't it, all this talk about maybe a common currency with our cousins across the Tasman, and you do see the gulf ever widening. It rather sort of puts paid to that debate ever taking flight.
Different economies.
Yeah, indeed. We like to sort of judge them on their merits. Thank you both, Quentin Quain from FIG Securities there, and Sally Auld from JP Morgan. Have a great morning.
Thanks, Carl.